Hi, everybody. Welcome back to the first full week of Hack the Orb. So I want to thank everybody that signed up and joined our presentations over the weekend. We had two great presentations on Saturday. First, Michael Fig took us through how you should set up your Agoric environment, talked through some things, showed him doing it himself live. So if you did miss that and you're either having trouble or have questions, reminder that all of these videos are recorded, so please go back, take a look, and reach out to us. And then after that, Kate Sills walked through two basic dApps that she had set up in the system, a fungible faucet dApp and a baseball card store. Today, we are going to transition into more of a DeFi-centric mindset. So we've got two great presentations coming up. First, we have Joe Clark, who is he's affiliated with RMIT's Blockchain Innovation Hub. He works with Agoric, and he's a former options trader for an Australian sovereign wealth fund and a former, he calls himself, reformed economist. He is going to take us through his version of call spread maximalism, which is, and I'll let him intro his own talk, but the way I view it is how can you take a call spread and apply it to a number of different financial instruments? So we'll have Joe come in and give that talk, and then at noon Eastern, 9 a.m. Pacific, Chris Hibbert from Agoric will come in and talk through how he has implemented a call spread in Agoric. So stay tuned there. You'll actually get a code walkthrough and understand how we've implemented this. So with that, I'm going to bring Joe on, and we can get rolling.
Thanks very much, Roland. So I thought in the spirit of DeFi maximalist claims that I would make a maximalist claim about, in this case, a particular financial instrument. And what I claim is that a call spread, which is a call option and a sold call option considered together as a structure, that you can take that and make special cases to make pretty much every other financial object that we have a name for. This claim can probably be made about a few different basic constructors, but for reasons that I hope to go into, I think call spreads are the most natural one. If I can move my slides. So specifically, I'll go through what a call spread is, and then how we can take special cases of it to make these lists of progeny. We can make call and put options, European call and put options. We can make futures. We can make binary options, which are 1-0 options, state options, which are a generalized kind of 1-0 options, prediction markets, obviously. And also, we can make collateralized loans, which is something which, if we're able to have a language to talk about the collateral and the margining of a derivative, then we can construct what we would consider normal, very simple collateralized loans as a special case of these call spreads. We can also very naturally do things like insurance markets. Insurance is best, most insurance contracts are best described by something which looks like the structure of a call spread, as we'll see. So a very generic description of a derivative, which is even more general than a call spread, has these set of things. And by specifying each of these, we can create all of our examples. There's a set of underlying states, underlying things that can happen, which will affect the derivative value. In the example here, it's just all positive values can happen. Perhaps it's an underlying price, the price of oil, or the price of the S&P, or the price of an exchange rate. There is an expiry. You might have something expiring in December. There is a value function, and in the picture here, the value function is just this flat function, which then is linear up and then flat again. and that defines how much the derivative is worth at expiry, depending on how much the underlying value is worth at expiry. So underlying on the x-axis, the value of the contract on the y-axis. There will be a currency that the underlying is naturally expressed in. And in this case, it might be US dollars. And there will be a currency that the collateral that we put up against this contract will be expressed in this case, maybe just US dollars. There will be a margin function. So with any derivative has some liability that both sides will generate. They'll either make money or they'll lose money, and they'll have to put up some amount of money at the start in order to satisfy the possible losses that they'll make. And so the collateral that they put up against it, one of the simplest rules for that is that they both put up the maximum they can possibly lose in the contract. There are other ways that the margin can work, but that's the idea of a margin, is how we specify how much collateral is being put up at different times. And there's a liability function which is specifies how the value of the contract changes over time. So this is the picture that we'll look at. We'll take this picture, which is actually a picture of a call spread, and we'll bend it around a few different ways in order to make all the things that we've claimed. And then I have a couple of general comments on how these things kind of hang together inside exchanges. So in the picture, the size of these blocks, there's blue and green blocks. The width isn't important, it's just there to draw the eye, but the height is important. So we're saying here that the one side of the contract, which we'll call the long side of the contract, is putting up this amount of this green amount of collateral, and the other side of the contract is putting up the blue amount of collateral, and those sum to the total to the height of that value function, which means that the function will be worth some amount, and that will be split between the two at the end. So, for example, we might have a contract which looks like this: starts at 20, ends at 30. And what it's saying is that if the underlying value is worth less than 20, the contract's worth 0. If the underlying value is worth greater than 30, the contract is worth 10, and then it's linear between those 2 points. So the total value of the contract that is being split up in the contract will be divided between these two sides will be $10. The two counterparties get together at the start inside an exchange or some kind of an auction or price discovery mechanism, and they say, I'll put up, one says I'll put up $3, and the other says I'll put up $7. They're both, that's their margin, their collateral for the contract, and then the contract plays out, and at the end it'll be determined who gets that $10 or what proportion of that $10. We have like we use the notation, this plus notation, to indicate the maximum of the number in 0. So you could say this is like the state minus 20 minus the state minus 30, and that gives us this piecewise linear function. In general, we can put some notation to it. We use K1s and K2s. We'll, instead of this initial value, 3, we call that V0. I won't go too much into notation, but just so that we can contextualize this. V0 is the value at trade time. What the two parties actually see. This is the price of the contract that they'll see. Yeah, that's a basic call spread. So what can we do with that? Well, one thing we can do with it is take the two strikes, K1 and K2, and make them approach each other, make them equal each other. And when we do that, we get a vertical function here, this step function. This is called a binary contract, and what it says is that if the price is if the price is less than 100, the contract is worth 0. If the price is greater than 100, the contract will be worth 1. So $1 will get split up between the long and the short side of the contract. And in this here, we're saying that in order to enter this contract, one side puts up 20 cents and the other side puts up 80 cents. They're both collateralized to the maximum possible loss, and that will be split. Either $1 will go to the long side or $1 will go to the short side, and the other side will get nothing. This kind of contract has a nice side effect, and that is that the price of the contract in this 20 cents is something like a probability. You can kind of say that the probability that the market is saying, given this arrangement between these two parties, is that there's a 20% probability that the price will be less than 100 and an 80% probability that it'll be greater than 100. So as with prediction markets, the price is reflective of a probability, given that the maximum value is 1. So that's the first thing we can do. The second, we can kind of, use this in notation. We'll call this V0, our initial price, and we'll call this 1 minus V0, the same in the example. Second thing we can do, we can restrict the states. So now we have, same as the previous contract, this binary contract, but we now say that instead of all possible states, it's now, it can only be 0 or 1. And this is very familiar as a prediction market. We're saying that there's a 0 state where the horse doesn't win, and there's a 1 state where the horse does win. So if I'm betting at the track on Mr. Pickington, who's a horse in the 3rd race, then I might put up 30 cents to try to win $1. Same as the binary contract, but again, now there are no intermediate states. There's only 2. And again, we're not dwelling on it, but the strike and the collateral currency are the same. We'll change that in a second. So in general, V0, 1 minus V0 for prediction markets. Now we get to something interesting. Now let's say that I'll say that the K1, my first strike, I take that all the way to 0, and K2, I take to infinity. And so now I don't have the flat parts of my function, I just have a straight line. And this straight line is called a futures contract. Now the issue with the futures contract is that there's a maximum loss for the short side, but there's an unbounded possible loss for the long side. So it isn't possible to fully collateralize a futures contract simply because the price can just go up and up and up, and the short contract will have to pay more and more and more. And so what happens on exchanges is that we have this process of margining. The idea being that I put up some amount, some fraction of the contract value or some other, maybe just a fixed value. And as the contract value changes, I'm required to put up more collateral, or I might receive collateral back. And that process, the value that I'm required to put up is the margin function. And if I breach the margin, then the contract is entitled to terminate, so that it's able to just sell out, and I might have some kind of a penalty. And the contract, then the person can simply try to find another counterparty. If that buffer is large enough, then futures trading is safe. But in general, it requires a lot of, the exchanges have to be careful on how much margin they require. So in this case, the futures contract is for 100, which we're saying that we think the price of this is going to be 100 at expiry, more or less. And each side puts up $10. So we put up 10% of the contract value. And so the contract can move a full $10 in either direction, and we still will have enough margin, but then we implement margin calls and make sure that there's $10 buffer, not just $10 in total there for each side. If we have something like a futures contract, we have to have an additional oracle. We have an oracle for the state for the outcome on our x-axis, but now we need to have an oracle for the value of the derivative at any time, and that can be sometimes we can just use whatever the state happens to be now. Sometimes it's a little bit more complicated, but the price that we pay for futures is one, that we have to have margining, and two, that we probably have a second oracle. In general, we just put some letters to that instead of numbers. Now call option. So we have, if we simply make K2 the second strike unbounded, then we just have a traditional call option, which is a flat payoff and then a 45-degree line. And here the long side puts up the price of the option. The short side, we have question marks in here, not because it's not known, but because it's slightly, there's a few different ways that you can do it, and it's slightly involved. The idea is that the same as with all margining, that the short side puts up enough so that there's a buffer if there are changes in the values of the contract, and there's time to ask them for more collateral before shutting them out of their contract. But it's messy, and there's a few different ways to do it. Hence, that's the question marks. A put option is a structure with a flat payoff and a straight line in the other direction. We construct this. We're entitled to construct something of this shape because we take a call option and we minus the future. And if you have the call option payoff and minus the future payoff, well, we get this structure of payoff. We have slightly more exotic thing, a state market, beloved by economists because there's a theoretical underpinning of some certain types of macroeconomics, which talks about everything being a function of state prices for events, and we might have an event of the underlying price between being 10 and 20, with a maximum with a payoff of 1, and that gives us a state market. The way we've constructed things, this is a binary, one binary minus another binary. And we still haven't touched strike and collateral currency. But this is good. So we have pretty much all synthetic markets now that you would usually you see on a derivatives exchange, call and put options, binaries, and futures. And they're fairly simple constructions. And you can use this to implement how things are generally implemented is easily done in this way. General state market, V01 minus V0. Now we turn to a collateralized loan. This is a bit crazy. So we take our call spread, we say that the first strike is now equal to 0, and we actually the strikes here are now arbitrary, but we say that there's only one state. There's only which is only 1. So the value function is just flat. It can only ever be 1 no matter what happens to the underlying state, which is to say that there's no underlying state. There's just one. Just the value will be 1 at the end. And what this is a loan. The contract says, I will pay $1 at the end. My liability is $1 at the end of this period. And it's $1 no matter what happens. And that is recognizable as a loan, as the way we would think of a loan. Of course, the collateral, if I have a loan and I put up collateral, I can't put up collateral in the same currency. I can't put up $100 US of collateral to receive $100 US loan. I'll put up $100 in Australian dollars or Bitcoin in order to receive that loan. And here's where striking collateral currency matters. So we might say that the strike currency is US dollars, it's a US dollar loan, but it's being margined in Bitcoin. And the margin function, and this again is familiar from the way that we do vaults, that we might say we would demand to have 1.2 times the value of the loan in Bitcoin at the start in order to have the loan. The reason why the short margin we have here is 90 cents, and the reason it's 90 cents is because there's an interest rate. The lender, the short side, puts up 90 cents and then receives $1 at expiry, and they do that because they demand to receive an interest rate in order to induce them to make the loan. That interest rate will be partly just they're determined by their discount function, but it'll also be determined by how likely they believe that the other side is to default, or that how likely it is for the price to move fast enough so that they won't be able to liquidate the collateral fast enough to satisfy the loan. So yeah, it's a call spread. Maybe it's trivially a call spread, but we can take this same idea of having different strike and collateral currencies. We could take it to any one of our previous. We could do the same for futures or call spreads, or binaries or what have you, and we would have the same kind of dynamic where now the collateral we require an over collateralization in the collateral currency in order to satisfy our liability in the strike currency. So that's our collateralized loan. In general, we give these things parameters. We have like an over collateralization amount for the loan, and our V0 is now a representation of our discount rate. So now we have one of the reasons why this construction is nice is we have at the beginning prices being represented as probabilities, and if we have enough of those prices, then we have probability distributions, and we have families of probability distributions of the state at different points in time, and that is the richest possible information set that we can have about the underlying state, to have a probability distribution of what it's going to be at any possible future point in time. So we have that, and we also have discount rates, which is, say, interest rates. And through this mechanism, we're able to have discount rates for loans at any expiry, and that gives us a yield curve. And those two things together, these family of probability distributions and a yield curve, is what people would kind of see as the cornerstone pricing objects for finance. Once we have enough of them, then we can price other things from them. We can also do what's called spanning. So if I take a state option, which is effectively just looks like a little block, then I can add it to other blocks and build shapes. I can build shapes that look like functions, and indeed you can kind of see it almost obviously. You can build any shape of function that you desire. If I wanted to create something which looked like a sine wave, I would be able to create that as a limit of smaller and smaller blocks. And so this is very, very helpful. It means we can transfer. If I know the price of a series of call spreads, then I can know the price of a series of blocks. And if I know the price of a series of blocks, I can know the price of a series of anything which is built from those blocks. And that's very useful, because it means that if I come up with a strange shaped pricing function for strange shaped value function, then the price of that can be quickly known and determined and hedged in the market for these other securities in a clear way. So that's probably what I wanted to get into, apart from a couple of kind of peripheral comments. So we have, again, these choices. For our underlying states, we can have a discrete set of states, or we can have a continuous set of states. They can be all possible real numbers, or they can be all integers, or whatever we like. In the case of prediction markets, there'll be ones and zeros for the states. We can have an expiry. We have to have an expiry. We can construct perpetual futures and perpetual options, but those things are really constructions which use the fixed expiry versions and then add a pooling element on top. And so it's best to think about them as fixed expiry first, and then we can construct perpetuals if we wish. We have a value function. Flat value function is a loan. Linear value function is a future. A piecewise linear function is an option. There we can do non-linear functions as well. Once we have call spreads, then we can create other non-linear ones in this spanning manner. For collateral, which we can choose that it's either the same as what our strike is measuring in the same currency, or a different one in the case of loans, or if we want to do cross-currency collateral. The margin functions, maximum loss is the default margin function, where you end up in DeFi, obviously the most desirable, that no matter what, you're going to have enough collateral to cover this loan, to cover the liability that the derivative creates. Of course, this isn't possible in the case of futures or call options, or indeed for loans. And so we have to have a margining mechanism, which is a function which looks at what the state currently is and tells us how much buffer we need to put up in order to satisfy that. If we don't make that margin, if we don't keep that buffer, then the contract will exit. It will liquidate the collateral, and there might be some kind of penalty to whoever has not put up the margin in time. And there is a liability function. The liability function usually is just the change in value. There's the difference in the V0 minus whatever V ends up being, but it can be more general. And so that's it for our set of things. You can go through, and any contract you can imagine, we make this set of choices, and we take a call spread, and we make a special case of whatever our building block is. A peripheral comment for our call spread. Our most general version of which is a call spread, which has a different collateral and strike currency, and is partially collateralized in the sense that it's not maximum loss. We only put up part collateral. We end up having three oracles: the state oracle, which determines what the state is; the currency oracle, which determines the exchange rate between my collateral currency and a strike currency; and a value oracle for determining how the margin should think about the value of the derivative over time. And that is that can be very hard. If we have a traded price that we can see, there's a liquid market which trades in depth, then we're able to take prices from that and use those as the value oracle. Sometimes what we can do, if we don't have a deep market, then we can use a parametric margining mechanism. And that is simply, a good example is for a loan. If we don't know the current interest rates will fluctuate on a loan over time, but we might look at a nearby loan, a loan which has a similar characteristic. We might figure out from what the interest rate is on that loan, and we would use that interest rate from this other nearby loan in order to margin our current loan. In the case of options, we can use option pricing formula. So I don't know how a particular option should be priced, but I can say, well, it's going to be between these two values given this option pricing formula under a plausible set of scenarios. And so I can use the pricing models as ways to get bounds to have sufficiently safe amounts of collateral. And that's the usual approach for when we don't have a liquid market. So which is to say that it's hard, but it's doable. It's just a matter of thinking a bit creatively about it. There's a couple of the issues I just wanted to quickly touch on. First one, liquidation penalties. If we don't make margin, then it's usually good to have some kind of a penalty to incentivize people to make sure that they have enough margin. In the case where you have both people have a symmetric risk of not making margin, sometimes we can create a penalty or a set of penalties which will give them balanced incentives not to default. So there's a whole kind of rabbit hole of thinking about what kind of liquidation penalties, depending on the relative amount of risk that each side it poses to the other in the contract of defaulting. The span margining is if I'm trading lots of derivatives at the same time, then instead of looking at the maximum loss for a particular derivative, it could be very desirable to look at the maximum loss across a spectrum of a span of derivatives that I hold. I might be long and short different kinds of call options on the same underlying, for example. And if I construct a margin function which is aware of the other derivatives, then it's much more efficient, and it's much easier for market makers to participate and for everybody to participate in a way that is still safe. And that means that the contracts have to know of each other's existence. They don't have to. The simplest version, they don't. But if we want to do proper exchanges, then we do need that. Margin insurance, and this is another kind of rabbit hole, but something worthwhile mentioning. The main derivatives exchange in the world at the moment is the Chicago Mercantile Exchange, and the main service that they provide is to be the counterparty to everybody's trade. If I go there and trade a future on crude oil, then I don't worry about the risk that whoever I traded with won't make margin. The exchange takes on that risk for me, and that's what they get their exchange fee for. For taking on the risk that some amount of people will, the price will move so much and the buffers will be insufficient, and they will have to make good on that trade. And so they hold capital against that contingency. It is possible to do what exchanges do to essentially provide that insurance against margin default in a decentralized way. And as a quick sketch, it's just the same as with an exchange. I take a pool of capital. Somebody says, well, we're happy to put up this pool of money, and in this well-defined set of circumstances that the price moves sufficiently so that this person is out of margin, we're able to, we'll come in and we'll make good on that contract. That liability itself is a special kind of option and can be priced in the same manner as the options on the underlying states. It's, again, just to mention it, partially because we're doing a paper on this topic, specifying how an exchange we can get the same outcome as you and the same safety that you have on an exchange, but in a decentralized way with margin insurance. And finally, we haven't talked about path-dependent derivatives. All our derivatives have only been, the value function is only determined at the end. It's possible to have derivatives that, and this is the exception to my universalist claim that call spreads can make everything, and that is that there are some derivatives which are dependent on the price at each point in time. And for those we need a slightly more complicated construction. And I think I'll end it there, and see if Rowan is still on the line.
Thanks, Joe. And so as always, please do send questions into YouTube. Feel free to connect with us on Discord and send questions as well. We know that a lot of you are watching these videos asynchronously, so we are still around, obviously, for the next 2 weeks and forever after that. If you want to engage with us on Discord, Joe is an active member of the team, and we can, reach out and get his assistance when you guys do have questions. So we'll leave it for a few seconds and see if any come in, and otherwise happy to end it here and bring people back on it at noon for Chris Hibbert's presentation on actually implementing the call spread in Agoric. So we did have one question just came in, Joe. So the pricing for insurance for the margin, what does that cost?
So the risk that's being priced is that the price will jump more than the buffer, more than the margin over the period of time in which you're not able to liquidate. So maybe like you have there's a minute period that you're not able to do anything as the price changes. And so if I have a very short-term call option on with a strike price equal to the value of the liability, and which I can determine at each point in time, the value of that option, whatever it happens to be, is the value of the margin insurance. The whole sequence of insurance is a series of forward starting options, because we don't know what the strike will be at any point in time. So that's generally called a cliquet, and it's just a series of options which have strikes that we don't know yet, but will be determined in the future, and they're determined at each point.
That pricing would be independent of the individual parties in the transaction, right? It would be defined primarily by got it.
Yes.
Great. So that would be something that someone could implement across their system and not have to worry about an individual. Yes. Great. Okay. And with that, I think, as I said, let's pull questions into Discord and we can continue the conversation. So thank you very much, Joe. Really appreciate it.
Thanks so much, Ron. Cheers.
All right, and so we'll take a 20-minute break, and Chris Hibbert is going to come on to show the implementation of a call spread in Agoric. In the meantime, those of you that are part of the hackathon, as always, join the Discord, Put your project and your team members up on our sheet. Engage with us in support. Ask questions. Engage with Chainlink. And we're here over the next couple of weeks and really excited to see a couple teams already building some interesting stuff. So it's going to be a great week, and we will talk in 20 minutes. Welcome back, everybody. So for those of you that were unable to come to our first talk today, we had Joe Clark come in and talk about how to use a call spread across a variety of financial instruments, whether that's a binary option, future, etc. And that's an interesting piece of work that he's done. He's part of the RMIT Blockchain Innovation Hub. He's an economist that's been working with Agoric, and he's a former options trader. And now we have Chris Hibbert of Agoric fame coming in to talk about his implementation of the call spread contract in Agoric. So we're going to get a code walkthrough and understand a little bit more specifically about how to actually work with the construct that Joe was talking about earlier today. So this is going to be a great talk. We're really excited. And again, just as a reminder, please do join the Discord. Please engage with us there, where we've got the whole team available to answer questions. And we know a bunch of you have already started doing that. And we want to just make sure that you're all in there and getting the support you need. So with that, I'm going to bring Chris on and we can get rolling. All right,
Thanks,
Chris.
Roland. Thanks, Roland. Good. Okay, so I've got my screen up there now. Thanks, Roland, for the introduction. Thanks, Joe for the talk he gave earlier. If you're watching this recorded later, you may want to take a look at Joe's talk. I'm going to refer back to some of the things that he said. I'm going to go through a implementation of a call spread that we wrote here at Agoric.
Chris, you may want to zoom in a little bit as well. The text is a little small on YouTube, if you don't mind.
I already made it small. It's such a tiny window to look at all this code.
All right, best of luck.
Yeah, I'm used to using my full big screen to look at code, and looking at it through a tiny little window. I'll try and make do with this. This is an implementation of a call spread, as Joe Clark explained earlier. In my presentation of this contract, I'm going to talk about two major topics, each with a bunch of bullet points. The first overall topic I'm going to talk about is standard features of Zoe contracts. There are a lot of things that every Zoe contract needs to do, and so I'm going to go through how this contract interprets the terms, how it builds invitations, in this case, how it calculates the payoffs, how we do the reallocation. The second topic is the unique aspects of this contract. Every Zoe contract is going to have some things that it does differently. Why else would you have a new contract? You must be doing something that's unusual. There are a couple of things that are unusual about the call spread. It uses promises in a way that we hadn't seen before in contracts. I'll explain why and how we do that. And it uses the price authority, which is a kind of an oracle. And I'll talk about how the price authority feeds into this and what it does. So I'm going to start with the standard features of Zoe contracts. Actually, I think I'm going to start with I'm going to switch screens quickly and talk about what this contract does in the context of the call spread, and I've got a different screen to show with that. This one. So, now Roland has to bring up this window. So this is just a different version of the diagrams that Joe was showing in his presentation. It shows the price of the option call spread changing as a function of the underlying. So this is what I've implemented is a fully collateralized call spread, which means that prior to selling the contract, the two parties combined have put in the full price of the underlying, the full price that would be paid out later. The thing I want to point to here is that the thing that the contract has to implement is that at the closing time, the contract talks to an oracle to find out what the price was, and then it has to figure out whether the price is below K1, in which case the long side of the long position will get the totality of the collateral, or if it was above K2, above the second strike price, then the short position will get the entirety. And if the price is somewhere between K1 and K2, then we have to do this linear calculation to figure out how much to give to each of the parties. And so that's the calculation that the contract has to make, and that figures in a couple of ways. One is that there's a bunch of the code that you'll see that's about making sure that this happens at the right time, and then there's figuring out the right price and allocating it to the right party. So back to the code. Take just a second. I only need 6 clicks to do that. There, that's so we're back to the code now. Let's start with the high level. As I said, the things that every contract does. I've collapsed a bunch of code here. There's a couple of comments that I've collapsed and some other things. The main thing I want to start with is the shape of every Zoe contract is that there's a start function which takes the Zoe contract facet and does a bunch of things, and then at the end, let's see, I can do this. So my cursor is here, which means that the blue highlight shows that function, and so that function ends by returning a creator invitation. There's a couple of things that are returned conventionally. This contract only needs to return one of them. That's the invitation to the creator who's going to fund the entire contract. And here normally we would only export the start function for Zoe to execute. Here we've also exported another function just for testing purposes. So that's the one that actually does the calculation of the share of the collateral that goes to the long position. So that's the high level external view of that. The first thing that the contract does when Zoe starts it is it deconstructs the terms, pulls out the terms, and it knows. Actually, I've got a comment up here that I had collapsed that shows what the terms are. I don't see it immediately, so I'll go back to the code. Oh, actually, I wrote it here. Here's a listing of what's in the terms for this. As Joe talked through it, there's an underlying amount. We need to get access to a price authority to tell us what the price is. We have an expiration time and a timer. There's K1 and K2 are strike price 1 and strike price 2. And the settlement amount can be in a different currency. As Joe referred to, you can do this in 2 currencies, or you can do this in 3. There's the underlying, there's the collateral, which is the amount that will be paid out, and then there's the strike price, the valuation of the collateral. And here I've actually pulled those out as 3 different currencies. The issuer keyword record shows that there's underlying and strike and collateral. And so Zoe lets us distinguish all 3 of those so that we can pay attention to the prices. And you could make 2 of those be the same currency, but in this case, it's possible for them to be 3 different currencies. So that, for instance, you might have a call spread on the value of Apple stock priced on the NASDAQ, which is priced in dollars, but pays out in Japanese yen, for instance. So that's 3 different currencies, 3 different issuers. So back to the contract itself. We start by pulling out pieces of the terms. We're going to want the amount maths and the brands of some of these different issuers. We then start by asserting that the collateral and the strike math are both, the used as NAT math means that they're fungible currencies. And I only do that for strike and collateral. The underlying doesn't actually have to be fungible. It could be the price of you could be doing a call spread on the price of a magic shield or something like that. There's just one magic shield. If there's a market for it, then you can know what the price is over time. and be able to do the math on all of this based on that. So as long as the price oracle is willing to give you a variable price on the underlying, that's all that matters about it. It doesn't have to be fungible. I then assert that the strike price 2 is greater than strike price 1. That's just the nature of the call spread option. If you wanted them in the other order, just name them the other way. That's pretty simple. Here we need, we hadn't needed to do this in previous Zoe contracts, but because of the way we're issuing options to the holders of the long position and the short position, the issuer of the invitation needs to be known to Zoe. I may say more about that later. The way that we're going to implement this contract is that there's a creator who's going to fund the whole thing. That's what makes it a fully collateralized strike. So they're going to put down all of the money behind the contract, and there will be 2 options created from that let the long party and the short party each have a position that pays off depending on how much what the calculation produces later. And what we're going to do is make a collateral seat that we can allocate the funds to, so that we can assign those funds there and then get them back later. The way that works is I'm back down to the bottom of the contract. We start with make creator invitation is how a Zoe contract goes, and it. So I'm going to collapse the inner handler. So the way make invitation call works, the way make creator invitation goes is it's a JavaScript function that does a bunch of work and then calls ZCF.makeInvitation. And there's 2 sides to what make invitation is doing. There's the side from what Zoe sees and the side from what the contract is doing. Zoe is using this in order to return the invitation to the owner so that they can get it back later. And what Zoe does is when you call make invitation, you pass it the handler. Zoe invokes the handler, which does the work and returns the results of that. So in this case, we call that's the inner one. That's this. So what make creator invitation does is it makes the 2 invitations that will be the assets that the long position and the short position get. Those are pretty simple invitations because all they do is they don't do any calculation. They just give a payout at the end. So the outer invitation makes the pair of invitations, figures out the amount of those things so that it can put them in the inner invitations so that the holders of the 2, the long position and the short position, can tell what they are. I have a test in which the creator of the outer invitation, let's call her Alice, fully endows the whole contract and then sells one of the positions to Bob and gives the other one to Carol just because that was easier. So when she does that with Bob, Bob can actually look at the invitation and see what the value is. The value is the payout that he'll get later. So all of this is about creating this is about creating those two invitations. Those are here. So these inner invitations, as I said, they just assign a seat. I'll talk about the promise of stuff later. But these make option invitations are really simple. They don't do very much. When the outer invitation creates the inner invitations, this one actually checks the shape of the proposal to make sure that they specified collateral and the two option positions, and then it trades the settlement amount. It assigns, so the trade takes two arguments, a left argument and a right argument, and says what the two seats are. So the creator seat is here gaining the two options, so that those will be there. So that the creator will end up with those in order to be able to hand them out to the two parties that he's giving or selling them to. The collateral seat will end up with the entire collateral, the entire settlement amount, so that it can give them to so they can divide it up among the two parties later. So that's what the invitation looks like. Another piece of the standard part that every contract has to do, as I said, is about calculating payoffs. This payoff calculation doesn't happen until later. So we do some scheduling. I'll talk about the scheduling later, but what I want to point to right now is that at the time that that we get the result back from the payment authority, we'll call this function calculate long share. We'll pass in, I'm going to get rid of this window so that you can see all of this. We're going to pass in the strike math that allows us to do the calculations. If you look at our ERTP protocol, we have these math objects that let us do calculations according to the different currencies. This is a calculation of that has to do with the strike prices, so it needs to be done in terms of the strike math. Other calculations use other maths. I think I showed here we do some calculations in terms of the collateral. So this takes in the current price according to the Oracle, the two strike prices. If the current price is lower than K1, than the first strike price, then the position that we're on in that payoff function is below zero, and so the long party gets all of the money. If the price is above K2, if we're on the upper part of that curve, then the short position gets all of the payout. And if we're in between, then we're taking that proportional function, and what we need to do is just figure out where we are. Take the position of the price between K1 and K2, and take that percentage of the payout and assign it partially to the long position and partially to the short position. That's what this calculation does. So calculate long share comes up down here. This is called in payoff options, which is called from the scheduling, which I'm still going to get to later. The reallocate here is it calls reallocate to seat. I've got that collapsed currently. That's part of the promise architecture that's going on here, and so I'll expand that out shortly. I think that's the high-level overview of the pieces of what this contract does that are common to all Zoe contracts. So how we deal with invitations, how we deal with the payoff. In this case, trader real. I'll come back to that. The things that are unique about this contract First off, because we're giving the holder of the long position and the holder of the short position these options that will pay out later, but that from this contract they don't have to pay anything for. We could have done it with, if it was a margined contract, then each of them would maybe need to adjust their margin as the price changed. But this is a fully collateralized one, so there's no margin adjustments required. And so each of them just gets an asset that is an option that either does pay out up to a certain amount or doesn't pay out at some future time. And in order to make those tradable as Zoe assets, they need to be invitations that you can verify. You can see some of our other talks. We'll talk about how ERTP works. I'm not going to go into that in much detail here. The consequence is that those two options don't exist until they're created inside this function, inside make creator invitation. And so okay, the other part that makes this hard is that the holders of those two options, if we tried to require them to exercise their options before the closing time, then we can't force them to do that. And so if we assumed that they did that, then when the closing time came, if they hadn't exercised, we wouldn't have a seat to allocate the funds to. So this contract assumes that they might exercise after the closing time, and in order to make that work, we use JavaScript promises. You saw that up at the beginning here. Whoops, sorry, I don't mean to scroll around quite so much. At the very beginning of the contract, after we had done the validation, what I use is an underlying function that we have that makes a promise kit which returns the ability to resolve the promise, the ability to reject the promise, and the promise itself, which you can use to get the value that it's eventually resolved to. So I store each of those, one for the long and one for the short, so that I can use them again later. And that means that this reallocate to seat, which is going to get called when at the closing time, that one is here, that's the one I collapsed. What it actually needs to do is, sorry, this is scrolling faster than I expect. What it needs to do is get that promise back out of the array that I stored it in and wait for it to be resolved, which most of the time is probably going to be before the closing time, but it might not. And in the case that it's not before, then we have to wait for that to be exercised in order for the seat to be available, and then we can do the settlement at that point. And the way that we do the settlement is we get the settlement amount from the terms. So share percent, so reallocate to seat was called from down here. So this function is called once we have the price quote. Actually, I need to go back even one more step. Let's do this. So this is where we schedule the payoffs. We did that just as soon, sorry, scrolling slowly. There. So this is in the very beginning, make it invitation. As soon as we stored the collateral amount in the collateral seat, the settlement amount in the collateral seat, we also schedule payoffs. And schedule payoffs is here. This goes to the price authority, which is a kind of a price oracle. It's built on top of the Chainlink oracle. Patrick Collins will be talking about connecting up Chainlink oracles tomorrow morning, so you can watch that talk. or if you don't watch this talk until later, you'll be available already. So the price authority that we've written wrapped around the Oracle API has a method called quote@time, which takes an expiration time. The authority has its own clock that it uses. We pass in the underlying amount, which the price authority is required to know how to price. We pass in a brand so that it can tell us what the price is in the strike issuer, and this quote@time function will eventually, we do this E of term.price authority, which means that it's an eventual call, and so this schedule payoffs returns immediately, but this then function isn't called until the price authority returns a quote at the expiration time. And so when that happens later, this calls payoff options. It will have the price quote was the return value from quote@time. And so we're going to pass that quote amount into payoff options. So at some future time, we'll know the value that's available, and this will take that, and using the two strike prices, it will call that calculate long share function that I showed you before, passing all of these in. So this will give it the position from 0 to 1 that's due to the long share. Inverse is basically 1 to 100, because inverse assumes that it's a percent, and we'll just give the short side 100 minus what the long side gets. Then we call reallocate to seat. Remember, all of this is being called after quote@time return to value, but reallocate to seat is called at a time when we can't be sure that the holder of the option has actually exercised yet. So we're going to wait for them to exercise their promise. Then we'll have the seat. The share percent will either be appropriate to the long position or appropriate to the short position. They get symmetrical but opposite payouts. And we will then figure out the amount of the collateral that is appropriate to that one. If this wasn't time delayed from the time of the closing, we could have done the calculation once and applied it to both, but the two parties might exercise at very different times, so we have to do the calculation separately for each of them. And then we've got the seat proportion, and then we use trade. With the trade helper function, we can call into Zoe and pass in the gains of each side, and we don't have to say it. The trade function saves some work on the caller's end by requiring that if you say the gains on each side, you don't have to say the losses on the losses for that side. In this case, this seat is the seat that was passed in, the seat that was pulled out of that promise, and they're going to get their portion of the payout. The collateral seats that have been holding on to funds since the contract was created, and it's going to end up with it doesn't gain anything, and trade figures out how to subtract that out, and so it gets whatever remains from that. Then we exit the seat. I keep track of how many seats have exited so that when we're done, we can shut down the contract. We don't want to shut down the contract because the long position has closed or because the short position is closed. We need them both. We need them both to have exercised and been paid off before we close. So that's the scheduling. That's the promises. Let me just walk through the whole thing again and see if it all holds together. I think I've talked about all of the pieces. So up here, those are imports. Here's the comment. I defined some JavaScript constants to label the long and the short position so that I could index them in the array of promises. I already mentioned using the % calculation for the inverse. I talked through calculating the long share. This is the start contract. Zoe gets passed in. We use the terms to find the math objects and the brand objects that we're going to use. The quote object here was used to create the two options, I think. I told you about the assert. There's the seat. So we had to make an empty seat in order to assign the funds to the seat so that they were available at the end of the period to pay out. I talked about this reallocate. This is the no, this is the one I just did. So this is payoff options. We did this so that we get the two strike prices. We calculate the long share. We reallocate separately for the two so that they're not connected. I think I got all of this. Let me look and see if there were interesting questions up here. Call spread. Kate answered some of these questions. To be used as digital assets. Yep, I talked about the digital assets. You can't see them here. If anybody asks, I could walk through the test and show how they're used as. Actually, why don't I do that? Here's the test code. Good. This is the test case where we're selling one of the options. So I'm going to skip over a bunch of pieces. Alice is set up. Each of them gets some money in the beginning of this test. We use a manual timer. If you're writing your own contract and it uses oracles or price authorities, you'll need to use a manual timer. The thing about a manual timer is its API from the contract side looks just like the regular one. Sorry, I'm scrolling fast to get down to the bottom of this. But the thing about the manual timer is that the time only advances when you say tick to it. And we found this to be very useful in our tests for building these things. So I'm skipping over this stuff. So Alice creates the instance of the contract. I don't want to talk about this unless somebody asks a question. What I wanted to say is, here's Alice. She is collecting making her proposal, which says that it's what the long amount is, what's the short. So these two options she got from. Oh, okay, I need to go back a little bit. When Alice creates the instance of the call spread, she passes in these standard details and gets back the creator invitation. The creator invitation in its details has the long amount and the short amount, which are the amounts of the invitations that are the assets that the long, what we call the long seat and the short seat, the two parties that will own the two assets will get. And so her proposal to create this contract is that she wants to get the pair of options. She's willing to provide $300 of collateral, and when she makes the offer, she passes in the invitation that she got. She passes in this proposal, which shows those details. And she passes in the payment, which was created up earlier. That's going to be just $300 because that's her contribution. She gets payouts from this, and that's the two options that hold the payouts for the two sides. And I think she sells the long option, so she's making a an invitation here for presumably Bob, because Bob is usually the second party. So she makes an invitation for an exchange in which she's going to give the long option. She's going to ask Bob for $200, and so she does a deposit of the long amount, and oh, I see. In this case, I wrote it so that she sells them both, but I'm only going to show Bob. Bob wants to buy the long invitation. He wants to say this is the long option amount, and he can actually look at that and see what it is. So the Bob here makes an offer for that. He pays his $200. He makes his offer. All he has to do is give the payout. And then he'll end up with, he'll be able to extract. So this is where the long option payout is the payout that Alice got, which was passed to Bob, and Bob uses that as an invitation to Zoe. He doesn't pass in. We usually the offer call has an invitation and it has a proposal and it has a payment. But in this case, these two options are already fully collateralized. They're already paid for, so Bob doesn't have to provide any funds. So he just gets the seat immediately for it. He can ask for the payout, and then we have a helper function that lets the test assert that there's a particular deposit. And so in this case, Bob got 225 because the price, I have to go back all the way to the top to see what the terms were. Actually, what I want is the I must have set up a price authority here. So what the price authority saw was that the price of the underlying in this case was 2 simoleons, and the price authority is pricing on individual simoleons, and so these numbers are being doubled. This is $40 for 2 and $90 for 2, and the timer is going to expire on the second price here, and so the $90 is going to be between the 2 strike prices, and that's why Bob's going to get 225, and Carol has the other one's going to get 75. So that's a quick trip through here. If there are more questions, I'll be glad to answer them. Otherwise, those are the points that I wanted to make. The call spread option does some unusual scheduling and uses promises for the seats in a way that we haven't done before, but it's fairly standard in the way that it deals with the terms and the way it creates invitations. And like all contracts, it has to calculate payoffs and allocate the outcome to among the various seats. This one ended up using 3 different seats because it has a collateral seat in order to hold onto the funds during the life of the call spread.
Great, thank you, Chris, and appreciate you handling some questions. We did have some come in. Again, for those of you that are watching asynchronously, please do engage with us over Discord. We'll answer your questions whenever you need.
Did you get any in Discord? I only have the YouTube chat up.
No, it's mostly coming through YouTube. But I figure for those of you that do see it later, please send messages in Discord and we can engage.
Yeah. We'll answer questions on Discord later.
Great. Well, Chris, appreciate the time. This is a great walkthrough of an important piece of a DeFi application. So I think we're hoping that those of you in the hackathon working on DeFi projects might be able to leverage this.
Thanks, Roland.
All right, and that concludes our programming for today. So we have more coming this week, and again, if you are an active hackathon participant, join the Discord, chat with us there. Reach out to me. My name's Roland Grouse. You can find me in Discord if you need anything. Need either to be helped finding a team or ideas for projects, or you're working on something and you need some tips or to connect with the engineers. Please do just reach out, either in support or directly to me. And we are excited to continue the week starting tomorrow. So we're going to close down for the day, but again, we will be live asynchronously and excited to engage.